For the Chapter 8 lecture notes, what we'll be doing is talking about converting governmental funds into the government-wide set of financial statements. So in the Chapter 1 lecture notes, you don't have to turn to it, but I just want to show you here, financial reporting under GASB 34. On the last page, you can see here that we have to prepare governmental fund financial statements, proprietary funds, fiduciary funds. Then we basically take these three things and then put them together, and we have a consolidated set of financial statements called the government-wide. Now, fiduciary is money that doesn't belong to you, so actually you see there's no line going up here, so none of the fiduciary activities go in the government-wide. But governmental fund activities do go into the government-wide, but the problem is that government-wide here is prepared under the modified accrual basis of accounting. But government-wide financial statements are under the full accrual basis of accounting. So we have to change from the modified accrual to the full accrual so we can combine everything here at the top under government-wide. So in Chapter 8, we're going to be talking about converting from modified accrual to full accrual. So here we see it looks like a stop sign. It says change to the accrual basis of accounting from modified accrual. That's going to be the purpose of Chapter 8, talking about how you take information from here, which is modified accrual, doing a couple of steps to convert it to full accrual, and then combining it in the government-wide. Okay, so in order to do the stop sign set of steps, okay, this is the stop sign right here. In order to do the different steps, we're going to have to do a couple things. Remember, modified accrual has no long-term anything. Very important. Modified accrual has no long-term anything. So it has no long-term assets, and it has no long-term liabilities. So that's not good, because if we want to convert from modified accrual to full accrual, we have to look at this step here, number 2 in the notes. We have to add back all of your long-term assets, add back all of your long-term debt. Remember, I talked about the 60-day rule in the prior chapter. Okay, so we have to cancel that out. The 60-day rule says for property tax, if you use modified accrual, property tax revenue includes everything you collect now and within 60 days after the year is over. That's the modified accrual rule. We have to cancel that out when we convert back to full accrual. Finally, if we have any inter-fund activities, we have to cancel them out also. Okay, so these are the different steps. 4 different steps. 1, 2, 3, 4. Okay, so let's think about that for just a moment. I want to go over a couple of separate rules first, and then we're going to do a problem together that is going to help you to see how to convert from modified accrual to full accrual. Okay, so I want to talk about the modified approach for infrastructure. Okay, so if we do the government-wide financial statements, government-wide is full accrual. So we know full accrual allows you to have capital assets and you have to depreciate them. Like, for example, full accrual on the government-wide, you might have buildings and then you have to depreciate the buildings. Now, for government-wide, you can elect to use the modified approach. The modified approach basically means that there is no depreciation. Example, let's say that I'm the city of New York and I have the Statue of Liberty. The Statue of Liberty is never going to be sold to anybody. You're going to maintain the condition of the Statue of Liberty. You're going to paint it green or whatever. So there's no need to depreciate the Statue of Liberty because you're never going to sell it. Okay, so for the city of New York and the Statue of Liberty, they can use the modified approach. What does that mean? It means no depreciation. Okay, so no depreciation. If you maintain an inventory of the infrastructure, meaning that you keep records of everything. If you also do a condition assessment, track the condition, make sure that you're doing maintenance. Estimate annual cost to maintain, so you keep a budget for how much it's going to cost to do repairs and maintain the Statue of Liberty. And you keep receipts. You document that the target maintenance level is being met. If you do these 4 things, then you're allowed to do the modified approach method, and that means no depreciation. Another example of modified approach might be the city of San Francisco and the Golden Gate Bridge. Right? So the Golden Gate Bridge is never going to be sold, and it basically lasts, for all intents and purposes, we can say forever, right? Maybe not literally forever, but certainly longer than our lifetimes. So if you're never going to sell something, you're going to always maintain it. You can use the modified approach, and you have to do 4 things under governmental accounting to use the modified approach. Okay, second thing, collections. Okay, so if you receive a collection of something, so for example, if somebody donates to the Smithsonian 200 pieces of antique tools, right? Well, if you have a collection or if you have a fleet of cars, some collections are recorded and they are exhaustible. Like, for example, if you have a fleet of cars, the more you use it, the less it's worth. Cars don't last forever. So if you have a collection of vehicles that you use in a fleet, you would capitalize it, you would record it as an asset, and you would depreciate it. What if you have a statue? If you have a statue, you would capitalize it. It's inexhaustible, meaning that you don't use up a statue, it just stays there, right? So if you have a statue, what would you do? You would record it, and you don't depreciate it. Now, finally, you have this third rule. This is called the non-capitalization option. So if you have a collection of something and you hold it for public exhibition, education, or research, you protect it, and you're probably never going to sell it. But if you do sell it, you would have to buy something that's in a similar asset class. Then you can elect to use the non-capitalization option. That means don't record it, essentially, right? And in certain circumstances, you may have to record it as an expense, but just know that there's a third option here. Okay, so last thing we're going to do is talk about how to convert from modified accrual to full accrual. Remember, we have 4 steps. Okay, so in the lecture notes, I have a Chapter 8 quiz. So that's posted on Blackboard. So let's take a look at the last question. This is the Chapter 8 quiz. Okay, so we're going to take a look at the last question, and then the answers are already written here. So let's look at the modified accrual journal entry. That's on the left side here. And then we're going to look at the worksheet adjustment to convert it to full accrual. Okay, so if I zoom out here, you can see we have 5 different examples. Let's take a look at these. Okay, so first, if you purchase a building for $100,000 and you pay cash for it, what would modified accrual do? Remember, modified accrual has no long-term anything. So if you purchase a building and you use modified accrual, you can't debit building because you're not allowed to have any long-term asset, no long-term liability. So modified accrual, you would debit expenditure building, 100,000. You'd credit cash, 100,000. So that's what you would do for the governmental funds if you use modified accrual. Now, what would you do if you want to convert from here modified accrual into full accrual so you can put it in the government-wide financial statements? What would you do? You'd have to get rid of the expenditure, So you credit expenditure, that cancels it out, it gets rid of it. And you debit building, because building is a long-term asset. So you can see that the worksheet adjustment is getting rid of the expenditure, and it's putting the long-term asset back on the books. That would be number one. The second one is pretty straightforward. It says we have depreciation of $5,000. So what would modified accrual do? Nothing, because modified accrual doesn't record any long-term anything. So if you have no long-term asset like building, then you don't have to have any depreciation, right? So you would have no journal entry here. What if you want to convert to full accrual? What would you do? Well, full accrual does have depreciation, so you'd have to debit depreciation expense and credit accumulated depreciation. Let's take a look at number 3 here. So for number 3, it says we have other financing source for $10,000. Okay, so you get cash, so you debit cash. This is modified accrual. You credit other financing source bonds for $10,000. Or if you don't want to use other financing source, this is sometimes called transfer in. So the point is, if you get money and you're using a modified accrual, you would debit cash, which is a current asset, and you'd credit other financing source or transfer in $10,000. This is modified accrual. So how would you convert from modified accrual to full accrual? Well, full accrual doesn't have an account called other financing source. So to get rid of it, you would debit other financing source, $10,000, and you'd credit bond payable, $10,000. So you get rid of the other financing source and you put the bond payable back on the books. Okay, here it says property taxes of $500 will be received 60 days after the year end. Okay, so remember, modified accrual means that property tax revenue is only property tax revenue if you collect it this year or within 60 days after the end of the year. So this money is collected after 60 days, so it shouldn't be revenue. So we debit revenue because it's not revenue. We want to make revenue go down. And you credit deferred revenue, right? It's basically the revenue is deferred until later. This is a special entry that you make for modified accrual. How do you convert from modified accrual to full accrual? Well, full accrual doesn't have this 60-day rule. It's not going to have this journal entry. So how do you convert to full accrual? Notice this journal entry is just the reverse of that one. You're canceling out the original entry. So you do the opposite. Last thing, here it says party expenditure is $200 and you pay cash for it. So modified accrual, remember it uses the term expenditure. So you would debit party expenditure $200 and credit cash $200. Now if you're going to convert all of this to full accrual, remember full accrual has no such thing as expenditure. So you credit party expenditure to get rid of it, and then you debit party expense for $200 to put that on the books. Okay, so for the Chapter 8 notes, just know the modified approach and the collections rule, and then make sure you know the journal entries, just the ones we went over, for converting from modified accrual to full accrual. And if you have any questions on Chapter 8, please let me know.